Okay. Kelsey, what's this first slide say?
What is the point of 704C and 704B? Or stated differently, what is 704C and 704B a tax concept? 704B is intended to track the economic deal partners agree to when a partnership is formed. 704C is intended to track the difference between the economic deal, which was 704B, and the tax basis of the assets being contributed. Stated differently, the 704C and 704B concepts are tracking mechanisms.
Okay. And based on what we've said so far, is that 1% clear, 99% clear? Where do you stand?
Clear?
Brett, is it clear to you?
Clearer.
Clearer, which we're going to keep hammering this. Okay, so as long as those words, Sam. Oh, you're so fucking lost. You don't know what to do with yourself.
I'm not.
You're not?
No, it's not as bad as I thought. So
Your eyes are lying. But we're just going to give you the benefit of the doubt here, Sam.
thank you. I appreciate it.
Okay. Sam, what's this slide say?
Says what is a 704B capital account? It's a fair market value capital account. 704C capital accounts, tax basis. Why do we care? 704B, which is a fair market value capital account, tracks the value the partnership owes you. 704C tax basis is utilized to track required special allocations of income.
Okay, so for those of you that were in here for that call, I don't know who was in here and who was not because I wasn't taking any sort of role because I was focused in on what I needed to do. That $13 million that was associated with Standard is a required allocation. And as you saw, the capital accounts started at negative 20 million and ended at positive 15 million. That required allocation of 13 million is what drove my capital accounts to intersect and equalize. Okay?
Can I ask you one question on that?
Sure.
What was driving those two one-time pieces at the bottom of your 704C schedule?
At the very bottom,
Yeah,
which was Holstone and
yeah,
Four Corners.
yeah.
So there were three things, and this is worth knowing, and we might as well say it out loud right now because we're going to hammer on this a lot. And 704 is one of the things that is really worth knowing and happens to us on a regular and continuous basis. This happens all the time. So in that schedule, there were three buckets of assets. Okay? And I got this in here somewhere. I'm going to say 704C types of assets. Okay, and again, Austin, this is somewhere in here, but let's cover it, and we're going to cover it. Repetition doesn't hurt us at all. Okay, one is, I'm going to call it immediate / short-term recognition assets. Okay, and an example of an immediate or short-term recognition asset is going to be cash basis AR. So if I contribute $100 of cash basis AR to a partnership, and I have a fair value capital account of 100 and a zero tax basis capital account because I don't have any basis in that AR, and the company collects AR 100% in 30 days, and I contributed on January 1st. Does the partnership have $100 worth of income within that first month? It does. So Austin, if you put in $100 of cash, and I put in $100 of AR, your 704B and C cap accounts are 100 each. My 704B is 100, and 704C is 0. So that short-term or immediate recognition asset, the collection of that cash basis AR, is going to be a $100 income event to the partnership, and I'm going to get a K1 with that $100 required allocation. And I got, again, let's go back to agreed upon and required. We're 50-50 partners, so it's 50-50, all income split 50-50, but the required allocation on that cash basis AR or immediate / short-term recognition says The collection of that $100 AR is forced my direction from a special income allocation. Okay? The second type of asset is depreciable asset. Okay? And we're going to hammer on that. The third type is sold in the future type asset. And man, these are tax technical terms. So if you look this shit up, that's exactly what you're going to find. Sold in the future asset. So the first three lines of that schedule, we had that $13 million that was forced in our client's direction, correct? And then you had that depreciation that occurred. So we had a short-term immediate asset, which was inventory. We had appreciated inventory, which they gave us value in our 704B capital account. But when those hogs were sold, that 13 million had to come my way because there was a difference between fair value and tax basis. The second was the category of depreciable, which was the $3 million going to the $50 million cash contributing partner. Then there was a $1 million pickup that I was required to have on my side to make all that whole. And there, to fast forward, there's under depreciable, there's traditional with curative, and remedial. And what we were looking at was remedial on the screen. That's what that was. And we're going to talk about those three items.
Because you had assets that had like 5-year lives, 10-year lives, 7-year lives, and you guys were saying, hey, we're just going to agree, hey, we're going to give this over 10.
Yeah, but that has nothing to do with traditional with curative or remedial.
Okay.
That's us coming up with a reasonable methodology to cure the inherent gain that was associated with those assets. Those don't conflate those two.
Okay.
But then sold in the future means that the only time we're going to have a required or forced allocation is when that asset's sold in the future. So what each of these have in common is the only time a required allocation is going to kick in and has to be allocated to a partner is when a taxable event occurs with respect to that asset. So in our brief example, we have immediate short-term recognition. Well, in that case, what we were looking at, they sold their hogs. In our example, the cash basis AR was collected. So therefore, there's a taxable event associated with that particular asset. Depreciable asset. Well, does depreciation affect the tax P&L? It does. So you have a taxable event associated with a depreciable asset. So you have to have a runoff with respect to that depreciable asset to calculate that required allocation. The third category is sold in the future. And the partnership interest of the two assets at the bottom were partnership interest. We don't know what those are really worth. There's no allocation that's going to be required until we actually convert that partnership interest into cash or some other taxable event like a failed 351 or whatever else. Okay?
Before you keep going.
Yeah.
Earlier we talked about required and agreed upon.
Mhm.
So the agreed upon, so like you and Aaron would be 50-50 and that would hit your tax capital. And then the required in your $900,000,
Hold on, let's be clear.
that's where I'm.
Okay, so what Sam's asking, this is a good question. Okay, so we're going to stick with sold in the future for a second, which is the land they were talking about, correct? And I think we have a slide in here somewhere that's going to demonstrate this on some level. So I have a 704. Sorry. Here,
Hey, you're fine.
thank you. You knew exactly where I was going. You have 704C, 704B, and you have inherent gain, right? We all agreed that those were our categories, right? And then we had Aaron and Pete that did the land earlier, okay? And you had Pete and Aaron, you have Pete and Aaron, and you have Pete and Aaron, right? And we said the economic deal was $1 million, correct? 1 million. And we said Aaron contributed cash, right? Okay, so Aaron's tax basis and his contribution's $1 million. But mine was 100,000, correct? So your question, and I got inherent gain for Pete of 900 and Aaron of 0, correct? And you're like, well, wait a minute, what's this required versus not required, and how do I know what the hell to do? Okay, so now, what land falls into which category? Is it short-term immediate? No. Is it depreciable? Sold in the future. So that inherent gain is sitting there waiting to be, to generate a required allocation, and the only time that's going to generate a required allocation is when? When it's sold. So now, we can push that required allocation aside from the thought process, and going back to what we said this morning, an S corp requires no memory, because if this was shoved into an S corp, that inherent gain is going to be split on a per share per day basis, and Aaron's going to have $450,000 of gain, or whatever the number is, coming his way. But in a partnership, we have to have a memory. We have to do this calculation and say 704B, 704C, and inherent gain. So now we earn $100,000 of rental income. And you're like, well, what do I do? I got the 704E account, I got 704B, what do I do? Well, they both have, that falls into agreed upon. So now we're going to have 50K, 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 50K. Because the agreed upon is going to hit both accounts. And that's part of something called capital accounts maintenance, is what that's going to be. So agreed upon hits both accounts. So let's do it this way. Agreed upon hits both 704B and 704C accounts. Required only hits 704C.
I was getting tripped up on the word required and which one. I got it. Thank you.
Yep. Sam, who you want to call in?
Alyssa.
Melissa, what's this say?
Okay, the following examples are intended to lay the foundation to discuss 704C concepts. Okay. Fact 1. Pete owns land A with a fair market value of 10,000 and a basis of 1,000. So what is the fair market value of Pete's ground? And if he sold the ground, what is the amount cash Pete will receive?
Okay.
Do you want me to keep going through the questions or answer?
Answer the question.
Okay. So fair market value is 10,000. And if he sold the ground, what amount of cash would he receive?
He'd get 10 grand of cash, wouldn't he?
Yeah.
Okay. What's 2 say?
What is the tax basis of Pete's ground? Is that the 1,000?
Yep.
If Pete sold the ground, how much gain will be reported by Pete?
9,000.
Yep.
Okay. Okay. So what's this say?
Jeff owns land B with the fair market value of 10,000 with a tax basis of 10,000. So what is the fair market value? It's 10,000. If the ground were sold, how much cash would Jeff receive? 10,000. Question 2 was tax basis of Jeff's ground, also 10,000. If Jeff sold the ground for 10,000, what is Jeff's gain? None. 0.
Okay. Keep going.
Okay, same as fact pattern number 1. However, the land has appreciated from 10,000 to 20,000. Basis of the ground remains at 1,000. So what is the fair market value of Pete's ground?
Yep.
So 20,000.
Yep.
How much has the ground appreciated since number 1? So 10,000.
Yep.
What is Pete's tax basis in the ground? 1,000. And if he sold the ground, what is the gain? 19.
Yep. Okay. Now, I don't know if I'm getting ahead of myself, Alyssa. I might be. It happens to me. So, I want to introduce a new concept here. And I think this is what I'm driving at when I'm asking these questions. Is that we're going to go back to this for a second. Okay? And if we talk about basis in the ground, how much tax basis did Pete have in his ground?
1,000.
No, up here. Sorry.
Oh,
I'm getting away from that. I'm coming back to the word.
okay. Sorry, say that again.
How much tax basis a contribution did Pete have in this ground?
Oh, 100,000.
100,000.
Okay.
Okay. What was the fair value of Pete's ground?
1 million.
1 million. So this is where this gets a little tricky because you have to know the rule, you know how to execute on the rule, but it's not intuitive. Is it intuitive that Pete went to the bank and either borrowed 100,000 or pulled 100,000 out of his bank account, went and bought a piece of ground? You can wrap your head around that concept because there was an actual action that took place.
Right.
Okay? But when we agree on what this economic deal is, there's a fair value basis associated with that. So what's Pete's fair value basis in the ground?
1 million.
$1 million. Okay? So now if the ground is sold for $1 million, how much tax gain does the partnership have?
900,000.
900,000, which would be specially allocated to Pete.
Yes.
Okay? So what we're shooting for, we're going to do this two ways. Okay? One, the ground is sold for 1 million. Two, ground is sold for 2 million. Okay? So the concept that is hard to wrap your head around, that's difficult on some level, is there's a gain-loss calc that occurs both for 704C and 704B. So if we sell at $1 million, proceeds is how much, Melissa?
1 million.
Okay, so we're going to go 704C and 704B. 1 million. How much proceeds is my 704B?
Also 1 million.
Also $1 million. What's my basis for 704C?
100,000.
100,000. What's my basis for 704B?
1 million.
1 million. So I have no gain or loss, correct?
Yep.
But I have a 900 gain here, correct?
Yep.
So this says, for 704B purposes, that there's no gain or loss that needs to be allocated. But for 704C, I got 900, and I got 900 of inherent gain, and I know who to push that to because it's required allocation. So let's now change that to 2 million. How much gain do I have?
1.9.
1.9. How much gain do I have?
1 million.
1 million. So going back to Sam's earlier question, what's this required versus not required? Okay.
Yep.
So how much gain? Well, let's talk about 704B first. What's Aaron and I deal? Economic deal. How are we splitting income?
50-50.
50-50.
Guessing.
So the million is going to go 500K to Aaron and 500K to Pete. Okay? But over here, we have Aaron and Pete. How much required income has to go to Aaron?
Based off like the 704C percentage that they get. Like how it's allocated.
How much inherent gain did Aaron come to the table?
900,000. Oh. 0. 900,000.
Aaron is 0 and Pete's 900. How much total gain do we have?
1.9. So you have 1 million left to.
Okay, so now we have agreed What's our deal? Economic deal?
250.
So how much does Aaron get?
So 500.
And 500. So 1.4 and 500, correct? So we're gonna come down here and turn this off for a second. How much 704B income was allocated?
500,000.
500. What does that foot to?
1.5.
1.5. Okay. How much 704C income or goes to Pete?
1.4 million.
1.4. How much goes to Aaron?
500.
500.
I see.
Okay. So this concept, which is hard to wrap your head around, and part of what I'm driving at here is, well, in this case, it was 10,000, which appreciated to 20. In this case, it was $1 million that appreciated to 2 million. You have this concept of you have a gain-loss calc that occurs for 704B, and your basis for that gain-loss calc is what amount did you agree upon was the fair value of that particular asset at the date of contribution. And your 704C kicks out what's required versus what's agreed upon.
Gotcha.
Is how that works. Okay, I think that's what I was talking about
Yeah.
there, but I don't know.
What happens if you sell for 500,000?
I hate that question. But let's do it because I'm never really sure, honestly. Let's see if we can make our capital accounts work. Okay, so if we sell for 500, and this is a 500K loss, correct?
Yep.
And we have 400K income, correct? Oh, Jesus Christ, what do we do with this? Honestly, we have negative 250, right, Brett?
Yep.
Negative 250, 750, 750. And it should equalize out. But does that mean I mean, it feels like this goes 400 here, I got 500, and this is 0, but my instinct is that's wrong. Because
You still have 400 of inherent gains sitting out there.
not anymore, I think it just,
Does it just go away?
I think so. Because that particular asset was transacted on. My instinct is this what's happened. This what happens because we only have 400 of income to allocate. And now we have a disconnect in between the capital accounts, and they are never going to equalize.
If you had a curative election out there, would you maybe shoot someone a loss and someone a gain to fix it?
Don't know. I hate losses. When I say I don't really understand them, that's exactly what I mean. Is I have no idea how that really works. I should, but I don't.
Wouldn't the argument be on inception of this partnership, Pete had a gain immediately, right? By getting 50% ownership that was worth 1 million in his land that turned out to be worth 500. He was essentially came out 500 ahead.
Well, I mean, the only thing, alternative is that this is 650, and this is negative 250. This is 750, and this is 750. That's the alternative.
Because if you in your world of like required versus what was the other word you used, agreed upon?
Agreed upon, yep.
Like to me, in theory, there's a required income allocation of 400 to what, Pete,
Yep.
and then there's a agreed upon loss of 250 to each of you.
Yeah, but where's that coming from?
fiction.
Yeah, I know, but at the end of the day, I mean, if this equalizes the capital account.
Agreed. If not, Pete's gonna get it. In your other example, Pete will get it when we liquidate.
Or more like Aaron has a cap loss when we liquidate.
Sorry, yep, I'm getting the two mixed up. And Pete has a cap gain. Wouldn't he?
Well, right now we say we sold it for 500. At that point, we have $1.5 million. Yeah. You would have cap gain.
So I think at some point it likely is to get resolved.
Oh, clearly, but when and how is kind of the question.
Yeah.
And whether or not that's on K1 or off K1, and if that's reported by the individual because they know what's going on, or we
Well,
footnote it or something.
It'd
along
be off
those lines.
K1 in
Right.
liquidation.
Correct. I agree.
But if it's a required allocation to say Pete gets 650 and Aaron gets 250, that's on K1.
Agreed.
I mean, so
I know from my perspective, a lot of these things that when this type of things happens, as much as we can include on the K1, we try to do so because again, otherwise you're going on the belief that that partner is going to know that there's some kind of off K1 income or loss that's needed, and you're never going to be so sure that's going to happen.
And the other thing I would say also is I think this literally, you could not have a simpler example of one asset ground in a 50-50 partnership. And we start doing these contributions where maybe someone's contributing an operating business
or
or
you two chat for a while.
we sold.
I'll be right back.
I feel like a lot of times we have to come up with shortcuts that work, that are practical versus right. Because if you did it to the, completely perfect way and tracked it on asset by asset purpose, it'd just be completely impractical to the point of being impossible.
Correct. And sometimes that practicality is maybe even allocating that entire gain in that year to that partner, because otherwise then the 704C goes away and you forget about it. And at some point, does somebody forget about a loss or a gain? And so do you allocate the gain in a way that cures the difference immediately, right? Rather than on the liquidation. And again, it's not right. And sometimes it's not great, but based on a conversation with the partners could make sense in certain situations.
Yeah, I've had that exact pattern in our capital. I was working on the capital district. We had multiple pieces of land in there with inherent gain. We sold one of the lots for more than what was the inherent gain on that lot. For the tax purposes, it didn't hurt the one partner with the inherent gain to pick up more than the inherent gain they had at the time. So we allocated all the gain from that sale to cure up some of the other inherent gain as well. But both sides have to agree to that because otherwise.
Right.
What were we talking about before I left?
We're talking about the practicality of 704C allocations and how sometimes you got to make some decisions about what's right and easiest for the long-term tracking versus what's technically correct. If you got a bunch of assets or
Actually, who sat in here while I was on that call? I mean, at the end of the day, we were on for standard, and the discussion of the right number of the runoff for the years was one of the focal points for sure. And we chose 10 years because the underlying depreciable assets were 10-year assets, a majority of them, and that's how we ran it out. And
Rather than bifurcating each by each different life. Right.
So you were saying allocate losses right away in the year, so you don't have to worry about it in the end.
Well,
the quicker you can
depends. Yeah.
cure your 704C, 704B difference, the less likely that it gets missed completely.
Yeah, and so if it would get
It'd be gains, not losses. Right. Well, I guess it could be either.
like in
So, like,
this,
Brett,
this
I'll give you
situation.
a practical example. I think Pete helped us set this up. It predates me. But like Heritage runs a group of nursing facilities and probably
oh shit, yeah.
yeah, it's a messy one. And they started by contributing maybe like 15 properties to a holding company that had 100 investors. And since then, probably every 3 or 4 years, the kind of core 8 people contributes a new one that they've invested in, gotten up and running, stabilized, got leased up, all that stuff, because the holding company that has all these different investors wouldn't want to take the risk to go pull something out of the ground. Okay? Well, every time that happens, I have to run a huge calc that says what's everybody's tax basis capital, what's the fair market value capital that they have in this thing, and then I restart the 704C clock for the entire thing, even though some of those properties were contributed 15 years ago. So I'm doing one 704C asset. I picked 30 years because that felt like a reasonable life for multi-family senior care. And, basically I have stuff that was contributed in 2012 that had a little bit of 704C left, and I'm just restarting it when I contribute an asset each time. And that was the most practical way to do it. And then we say the rest will get cured when we eventually liquidate. But if you start tracking 25 different nursing facilities by their fridges and their carpeting and their roof and the core of the structure and the land, there'd be
It's gonna be a $75,000
Yeah.
tax return.
correct. Versus like each time I roll this forward, it costs probably 10, 15 grand for the calc, but we know what it is and then we disclose it to everyone so people know who have really big inherent gains, and it'll get solved at the end. And it's the most practical way to do
So
it.
if you're doing that year over year, that's all ordinary income items.
Yep.
If you would wait and then it's a liquidation problem in the end, could you potentially have capital or
A lot of it would
character?
probably be cured with 1250 if I ventured to guess.
Yep.
So yes, but there's for sure rate play there too.
That's a specific heritage. That's specific to heritage, though.
But the same would tack to any real estate probably, right?
For real estate, sure, but for
Tables and chairs.
no, for something that has intangibles, part of their built-in gain.
Yeah.
If LRS were in a partnership and Jeff contributed to the partnership, there's a huge intangible there,
Yeah.
which is capital in nature.
Yeah.
So that asset that's capital in nature, we have those 3 buckets: short-term, depreciable, and something that's going to be sold in the future. Well, intangibles, how hard is it to send me an invite? Intangibles are one that's going to be sold in the future probably, right?
Yeah.
It depends. And it's going to depend on whether that could end up with a required allocation depending on the methodology, which is traditional with curative, and remedial. And those choices, traditional with curative, and remedial, all have to do with depreciable assets. And if you have purchased goodwill, do you get to write off that goodwill? Over what period?
15.
Over 15 years. So, and we would demonstrate this. I'm planning on demonstrating this. Let's see. If you're using remedial, even though you don't have purchased goodwill, it can still result in an allocation.